Hello everyone, welcome to the 161st episode of me learning how to trade in Forex. So in the last episode we finished off going through using a multi-product strategy lesson. Basically we can engage with the stock market however we choose, so we may use different products simultaneously to help us meet our financial goals. And then we looked at some of the benefits of using a multi-product strategy. So for example, putting all your investments to one stock or account can be risky, as the value might increase, which means you turn a profit, but if your position doesn't perform well, then you're probably gonna end up with a loss. So benefits of using a multi-product strategy is that it can help better achieve your aims. So you might have different goals like saving for retirement or getting a car or something like that. A diverse multi-product strategy can help you support these and provide you with the money that you need when you need it. And with the wide-ranging approach, you could also use hedging to protect your portfolio from significant losses. I know we looked through at some of the common multi-product strategy structures. So basically it's common to follow the structure of a pyramid. So at the bottom you may choose to include various investment products as they're typically lower risk, and then as it gradually narrows up towards the middle, you could purchase individual shares, slowly increasing your risk level. And then right at the top of the pyramid you might include leveraged trading, so which is considered pretty much the highest risk you can do with your money. If your leverage positions does experience a downturn, so the ones with the highest risks, you'll only be losing a small piece of your overall portfolio because it's only a small percentage of your investment pyramid. So the key to a successful pyramid is to build on a solid financial foundation, aka your safe, non-risky investments, and limit exposure to more risky investments at the top. And then we went through some of the pyramid examples. So pyramid 1, combining different investment products, low risk structure, got managed portfolios and exchange traded funds. So for stability basically. Having numerous stocks mixed with some bonds reduces investment risk and creates a strategy that's relatively simple to manage. Does take more time, but this approach has the potential to produce returns ahead of inflation and create real wealth. Right, and we've got pyramid 2, adding individual shares to your strategy, so added value stocks and growth stocks. Difference between them two is growth stocks belong to companies that investors believe will deliver above average returns, but these tend to be volatile, so you're more likely to earn a profit from the quick price changes than from dividends. So this makes investing in growth stocks a little bit riskier, so you might make a loss on this. Value stocks refer to the companies that are currently considered undervalued by other investors. So here you're hoping to purchase the stocks that have demonstrated a history of good profit. So these remain steadier, the prices, market price rising slowly and greater likelihood of receiving dividends. However, as with any investments, there's no promise of future profits. Value stocks could be correctly priced by the market, so purchasing them might not be the bargain you assumed. And so individual stocks, part of the strategy, allocate some funds to dividend paying value stocks in the middle, and to growth stocks at the top. And then we've got pyramid 3, combining investment and trading products. So adding the top two layers of other leveraged derivatives and options trading. So although this will add more risk, it's less likely to destabilize the overall pyramid structure because of its sturdy base, which is our safe products. So these trading products can be used to further diversify your portfolio, plus they could be used to add some security if you choose a hedging approach. Right, and then we went through what options are basically, and how it can protect your losses. Oh no, not protect your losses, offset some of your losses. Done the quiz, and then we've got another pyramid, a trading only strategy. So leverage derivatives, individual stocks, or exchange traded products. But this could be trading alone could be a risky option because the base of your pyramid might lack the stability you could get from long-term investments. Yeah, and we've got Pyramid 5 using an options trading strategy, so other leveraged derivatives and options trading. So using vanilla and barrier options. So hoping that profit blend of call and put options on different assets could reduce overall risk in your pyramid because you profit from both the rising and falling markets. And yeah, and then we went through the lesson summary. So the methods that they've gone through in this lesson aren't the only options available to you. General idea is to structure your pyramid according to your own needs and risk profile. So you can choose whichever low, medium or high risk solutions which fits your financial goals. And now we're on to the quiz to finish up this how to choose the right product lessons. So, if you have a full-time job, which of the following trading styles would not suit you? Scalping, day trading. True or false? A drawdown is when one losing trade or investment dents 2% of your capital and negatively impacts your overall portfolio. False. A drawdown is when you have multiple losing streaks in a row, isn't it? Say you're building your portfolio and choose to include volatile stocks and several leveraged derivatives. Which risk profile is most applicable to your strategy? High risk. Which of the following financial instruments are leveraged? ETFs, company shares and bank bonds, contracts for differences, exchange traded commodities. Contracts for differences are leveraged. Exchange traded funds. I think both of the exchange traded can be leveraged. And that's it, yep. Which of the following could be considered benefits of trading with leverage? Benefits. Potential profits and losses are magnified. Take a larger position with a relatively small outlay. You can trade on rising and falling markets, all of the above. You open a contract for difference and buy 3 contracts on the FTSE 100, £10 per contract, and 2 contracts on the Nasdaq, £15 per contract. If both indices rise by 2 points, which positions will give you greater profit? So 3 times 10, that's 30. 2 times 15 is 30 as well. Both will give you an equal profit. Oh no, wait. Yeah, both will give you equal profit. Say a share in Apple Inc. is currently trading at 195.420. Marie thinks that the market price will appreciate, so she purchases 100 shares, contract for differences. By the time she closes the trade, the price has fallen to 194.210. What would her profit or loss be? She's made a loss because she's hoping that the price is going to increase from 195.420. However, it's decreased, so it's a loss. What's 195? Was it? Let me get the calculator up. 195.420 minus 420 minus 194.210. So that's 1.21. 1.21. She bought 100 shares, so £121 loss. Which of the following statements defines the difference between a spot price and futures price? They're the same thing, they're not the same thing. The spot price is the market price for an asset in a particular location, while the futures price is the price of a futures contract for an asset. Nah. The spot price is the current market price for an asset, while the futures price is the guaranteed value of an asset tomorrow. Nope. The spot price is the current market price for an asset, while the futures price is the price of a futures contract for an asset. Yeah, that one. John believes that the price of GBP/EUR is likely to fall. If he wants to trade it with an option, Which course of action will result in a profit if this prediction occurs? Is likely to fall. John should buy a put option. True or false? Our multi-product strategy includes both trading and investment products and creates diversification in your portfolio. True. 80. Okay, so full-time job. Scalping and day trading requires you to dedicate many hours of your day to monitoring your open positions. This is unlikely to suit someone with a full-time career. A drawdown is when you have one or more losing trades or investments that significantly dent your capital, drawing down the total value of your portfolio. A reckless or negligent trading strategy could cause heavy losses even in a single trade. Leveraged derivatives and volatile stocks are considered high risk because of their complexity. Alright, so only CFDs. Contracts for differences are leveraged derivatives and allow you to take a larger position on an underlying market by paying a relatively small outlay. All the above answers A, B and C are true. However, leveraged trading is not exempt from risk. Although you've bought fewer contracts on the Nasdaq, the larger contract value increases the overall gain, which matches the value of your contracts on the FTSE 100. So your FTSE 100 profit is 3 times 10 times 2, which is £60. Your Nasdaq profit is 2 times 15 times 2, which is £60 also, so they're the same. Because Marie went long and the market fell, she didn't benefit. Her loss will be calculated as follows. 195.420 minus 194.210 times by £100, which is £121, excluding any additional costs. Spot prices refer to the price at which sellers and buyers value a particular asset right now, which means they deal with immediate transactions. On the other hand, futures prices are created with delayed payments in mind. So, because he thinks the market is likely to depreciate, John should buy a put option as it will give him a short position. He would have the right to sell at a price that he set, which may be higher than that of the market. The further the market drops, the more profit John could make. Yep. Okay, so this one, while a multi-product strategy does create diversification in portfolio, it doesn't always include both trading and investment products. It can include different products from one category. Oh, right, so what's it called? You could do both trading and both lots of different asset classes in investments. So, for example, you could, my mind just go blank. You could invest in shares, invest in bonds, invest in different countries, different sectors. So that also diversifies your portfolio. Okay, yeah, that's what I was going to say. Yeah, cool. So, what lesson was that? That's how to choose the right product finished. How to choose the right product finished. How to choose the right product finished. Cool. And now we're on to, let me just check. Yep. Now we're on to tools for traders. Want to know more about demo trading accounts and how they work? Learn how to make the most of your demo account by using it before you try the real thing, and find out why you should test new strategies on it prior to giving them a go in a live environment. In this course, you'll be introduced to different trading strategies, how to track your trading performances, demo trading tips from our analysts, backtesting, creating a trading plan, how to set trading goals, and more. Very nice. So, what is a demo account and why use one? So, what is a demo account and why use one? 09/06/2024. Right, okay. Trading, by its nature, will always carry an element of risk. To help traders practice in a risk-free environment, many trading platforms offer a demo account. In this lesson, We'll look at what a demo account is, the benefits of using one, the type of functionality to look for in one, and how to open a demo account with us. In the following lessons, we'll explore what's possible in a demo account, how to test new products and markets, and understand and use demo account data. Plus, we'll share tips from our analysts to help you get the most out of your demo account. Cool. So what is a demo trading account? A demo trading account is sometimes also called a practice trading account, trading simulator, or paper trading account. Paper trading is a term used to describe simulated securities trading, which is another way of saying pretend trading of tradable assets like shares or bonds. So a demo trading account is also called a practice trading account, trading simulator, or paper trading account, or paper trading account. Paper trading is a term used to describe simulated securities trading, which is another way of saying pretend trading of tradable assets, like shares or bonds. Yep. In a nutshell, demo trading account lets you simulate a real trading environment using fake funds instead of actual money. So, demo trading account lets you simulate a real trading environment using fake funds instead of actual money. In other words, it's a safe place for you to practice trading without putting any of your capital at risk. It enables you to get a feel of the ways that different products and financial markets work. While there's no risk when using a demo account, it's important to understand that it's also no monetary reward. You can't earn returns from a demo account as it's a simulated trade. However, that doesn't mean there isn't a reward. Using a demo account can have several benefits, which we'll outline now, below. Why consider opening a demo trading account? A demo trading account could be useful to you in many different reasons. For example, advantages of demo accounts. Testing the waters. You're a beginner trader and you'd like to make sure you understand how trading works properly before setting up a live account. You're looking to learn the basics, understand the market dynamics, and get to grips with the trading platform without incurring any real-world losses. Ensure you know how trading works properly before setting up a live account. You can learn the basics, understand market dynamics, and get to grips with the trading platform and learn how to use the trading platform without incurring any real world losses, without losing real world capital or money. Trying out new strategies. Trying out new strategies. You consider yourself an intermediate trader. You have some trading experience, but you want to test out new strategies in real market conditions or try a different trading platform without risking your capital. You're looking to explore and experiment and build your trading confidence. So, testing out new strategies in real market conditions, or try a different trading platform without risking your capital. You're looking to explore and experiment and build your trading performance. expanding into new markets. Well, expanding into new markets. You're an intermediate or advanced trader and want to expand into new markets. Perhaps you started with foreign exchange trading and you're looking to explore indices, shares, futures or commodities. Every market is subject to different influences that will enable different kinds of market orders. Some markets might also feature varying margin requirements. Learning how these different markets operate may be easier in a demo trading environment. So, wanting to expand into new markets. As every market is subject to different influences and will enable different kinds of market orders and will enable different kinds of market orders. Some market might also feature varying margin requirements. Learning how these different markets operate may be easier in demo trading environments. So, learning how these markets operate may be easier in a demo trading environment. Improving your weakness. You're an intermediate or experienced trader, but you find that you tend to win in the same places and lose in the same places. If there's a market where your trades constantly perform well, you might decide to focus on that market in your live account and use the demo account to work on markets where your trades consistently underperform. If there's a market where your trades consistently perform well, you might decide to focus on that market live account. You might decide to focus on that market in your live account. Then using the demo account to work on markets where your trades consistently underperform. Nice. A demo trading account may benefit you wherever you are in your trading journey, whether you're looking to put theory into practice or improve your performance or to experiment in a risk-free environment. Did you know products that use leverage require you to make an initial deposit to gain full market exposure? For example, CFD trading, contract for difference trading, which enables you to speculate on whether an asset's price will move up or down without owning the asset, and spread betting, which is a popular derivative product used for speculating on financial markets, also without owning the underlying asset. While this can magnify your returns, it can also amplify your risk. This means it's important to get to grips with how these products work before you trade on live markets. Using a demo trading account, you can practice CFD trading and spread betting risk-free. Very nice. What other differences and similarities are there between demo and live accounts? While the biggest contrast between a demo and live account is that you're trading virtual money, there are a few other differences to be aware of as well. Beware of too. For example, trades made through the demo account won't be subject to margin call. You will not be charged for chart packages on the demo account, and any updates made to the live trading platform might take a little while to reflect on demo environment. So, trades differences between live and demo trading account. Trades made through a demo account won't be subject to margin call. You will also not be charged for chart packages on a demo account. Not charged for chart packages on a demo account. Any updates made to the live trading platform may take a little while to reflect in the demo environment. Any updates made to the live trading platform may take a while for it to update in the demo account. There are some similarities between the two as well. In both demo and live accounts, trade may be rejected if you have insufficient funds to open them. So similarities between live and demo trading accounts. Trades may be rejected if you have insufficient funds to open them. Trades may be rejected if you have insufficient oh god, that's awful. Insufficient funds to open them. Trades will also not be closed if you don't have enough funds to cover margin and running losses. So trades will not be closed if you don't have enough funds to cover margin and running losses. This happens with a live account too, but you face margin calls there. Right. Functionality to look for in a demo trading account. When considering opening a demo trading account, the first step is to know which markets you want to explore. So, when opening a demo account, first step is to know which markets you want to explore. First step is to know which markets you want to explore. For example, are you looking to trade Forex, shares, commodities, bonds, or options? Do you want to be able to trade in multiple markets from one account? If you like to create trading experiences across multiple markets, you will want to look for a demo account that gives you an access to different asset classes that interest you. Because traders will generally use a trading simulator to better understand real-world markets, it makes sense to look for a demo trading account that closely resembles a live account environment. So look for a demo trading account which closely resembles a live environment, a live trading environment. This ensures your simulated learning experiences will translate well into live conditions and equip you to make real-world trading decisions. Also look for demo environments that enable you to set alerts on markets you want to keep an eye on so you can react instantly to any price movements. So, look for demo environments that enable you to set alerts on markets you want to keep an eye on so you can react instantly to any price movements. Like in many other brokers, we offer a demo environment where you can hone your trading skills. So how to open a demo trading account? To open a demo account with us is simple. All you need to do is open your internet browser, navigate to the demo account page, fill in and submit the contact form. Once you've completed these steps, you have immediate access to your new demo account, where you can develop your trading skills in thousands of markets, practice trading £10,000 in virtual funds, get educational content on IG Academy, and test strategies on the go with our free mobile apps. If you're interested in using more advanced software, you can also get a MetaTrader 4 demo account with us. This enables you to build your understanding of the MetaTrader 4 online trading platform in a risk-free environment. So let's do a summary. A demo trading account lets you simulate a trading environment using virtual funds instead of real money. A demo trading account could benefit you wherever you are in your trading journey, whether you're a beginner or an advanced trader. Demo trading accounts enables you to improve your understanding of financial products and markets, to test new trading strategies, and to potentially improve your performance, all without any real world risk. So, very good. A demo trading account is your lab. A demo trading account is your lab. Just as scientific laboratory is a space equipped for experiments and research, your demo trading account is a place where you can test different trading strategies and investigate new markets and products. In this lesson, we'll look at some of the useful things that demo account enables you to do, such as using charts and trying out numerous trading strategies. Important basic terms. Before you can explore some of the more useful functions a demo trading account offers, you need a basic understanding of how to navigate around your account, and that includes knowing some key terms. These features might not be available on every trading or demo platform, but it's good to keep them in mind as you start your journey. So, important demo account terms. Workspace. As with a live account, this is the area where you can access the various trading instruments you might want to experiment with. Including indices, Forex, shares, commodities, bonds, exchange-traded funds, and options. From here, you can open separate windows to display information you want to view, including charts and graphs, alerts, buy and sell executions, orders, etc. You can add and save additional workspaces to prepare for specific events and markets, and tailor each one to suit your needs. Okay, so this is the area where you can access the various trading instruments you might want to experiment with. Including indices, Forex, shares, commodities, bonds, and ETFs, and options. From here, you can open separate windows to display information you want to view. So, you can open separate windows to display information you want to view, including charts and graphs, alerts and buy-sell, executions, orders, etc. So these include charts and graphs, alerts, buy and sell executions, orders, etc. You can add and save additional workspaces. So you can add and save additional workspaces to prepare for specific events and markets, and tailor each one to suit your needs. Watch list. A watch list is an important tool in your trading. Helps you to group potential assets to trade together in a single, easy to find spot. This means you don't have to manually search for markets every time you use a demo account. You can streamline your trading by accessing your watch list. So, helps you group potential assets to trade together in a single easy to find spot. This means you don't have to manually search the markets every time you use a demo account. You can streamline your trading by accessing your watch list. Yep. Trading charts. Charts are visual representations created by an asset's price movements over time. They can provide traders with valuable information about an asset's price and help them make estimations about future movements. Trading charts can create recognizable patterns, helping traders to source information about what the price of an asset might do next. While nobody can predict with absolute certainty how a market will behave, it's a common principle that chart patterns tend to repeat themselves. There are various types of chart patterns, trading charts, with the most popular ones including line, bar, and candlestick. So, charts are visual representations created by an asset's price movements over time. They can provide traders with valuable information about an asset's price, and help them make estimations about the future movements, about future price movements. Trading charts can create recognizable patterns. So trading charts can create recognizable patterns. So which helps traders to source information about what the price of an asset might do next, While nobody can predict with absolute certainty how a market will behave, it's a common principle that chart patterns tend to repeat themselves. There are various types of trading charts, with the most popular ones including line, bar, and candlestick. So there are various types of trading charts, with the most popular ones including line, bar, and candlestick. Trading plan. Before you start trading with your demo accounts, you need to know what your trading plan is. You need to have a plan before trading with your demo account. What are your goals and how you achieve them? What are your goals and how will you achieve them? This is your trading plan, the strategy you would implement in a live account. So your your trading plan is the strategy you would implement in your live account. However, in a demo account, your goals might be different. For example, if your objective is to improve on your weakness rather than playing it safe, as you might with real money on the line, you might use a demo account environment to work on markets where your trades consistently underperform. You can make decisions that you won't normally in a live environment to see what would happen. However, your goals in a demo account might be different, as you could be using the demo account to improve your areas of weakness, so you can make decisions you wouldn't normally make in a live account on a demo account. To see what would happen. Hedging. Although it sounds like a gardening term, hedging is actually about trying to insure yourself against factors that might negatively affect your financial position. So protecting yourself against factors that might negatively affect your financial position. You can't stop negative events from happening, but hedging strategies are an attempt to protect against the impact if and when they do happen. So hedging strategies are an attempt to protect yourself against the impact of a negative event if and when they do happen. Did you know? In financial markets, hedging refers to making a trade with the intention of reducing the risk of adverse price movements in another asset. In other words, you hedge one investment by making a trade in another. One of the most common markets in which traders practice hedging is derivatives, where they can develop trading strategies so that a loss in one investment is offset by a gain in a derivative. For example, let's say you own shares in the ACME company. You've invested because you believe it will pay in the long run. However, you know that there are some market conditions that might affect the share price in the short term. So you buy a put option on the company. This gives you the right to sell your shares at a specific price, meaning that if your stock price falls below that price, the losses will be offset by the gains in your put option. By making a trade with the intention of reducing the risk of adverse price movements in another asset. By making a trade with the intention of reducing the risk of adverse price movements in an asset, you hedge one investment by making a trade in another. Okay, so now that we've penned down some of the definitions, let's explore what we can do with graphs and charts. So in the next lesson or next video, we're going to carry on from where we left off at, which is how can I use graphs and charts. So thank you all for watching, and I will see you guys in the next video. Bye bye.